Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Frederick, Managing Director of Trading Derivatives at the Schwab Center for Financial Research, to discuss what to expect from Jackson Hole this week and perspective on the recent pullback. Randy, it's great to see you as always. Welcome back to Trade Talks. And of course, the market's focused on Jackson Hole and the expectations there. Recall in 2020, Powell used a symposium to announce a tweak to the central bank's approach to inflation targeting. What are you going to be looking for with the upcoming address at Jackson Hole this week?
Well, great to be back, Jill. I think a lot of people are talking about the fact that perhaps maybe Jay Powell will be a little bit dovish this time. I think I would think of it more about him not being necessarily dovish, but just being not hawkish. In other words, mostly neutral. And I think that's kind of the expectations in the market. If you look at things like the Fed funds futures, the probabilities of a rate hike in September are in the single digits or barely in the double digits, which means way below what you need in order to actually have that change. And even going out into November, we're only at about 30%. Normally, we got to be well above about 65% in order to get that change. So what it looks like to me is that we're probably going to see interest rates stay about where they are for the remainder of this year. And only then next year, if inflation continues to come down towards the 2% level. Now, Jay Powell has said publicly that he would like to see inflation rates at 2%. But I think personally, he's probably comfortable with them at 3%. But if he's going to say publicly at 2%, that means there's very unlikely that he's going to cut rates until it gets close to 2%. I don't think we're going to see that for maybe another 12 months. So I am not expecting anything that maybe rattles the markets at all this time. I know it's going to be a complete departure from what we saw last year, but I really think the markets are going to mostly just kind of yawn at what's talked about this time. And that would be a good thing.
Yeah, I would agree. I'd be super surprised if he did anything to reverse course. I guess that's one way to achieve your targets, is to kind of move the goalposts a bit. What about yields? Highest levels that we've seen since 2007. Yeah,
we're at 16-year high yields on the 10-year. And that's a really interesting scenario because we're actually seeing the inversion of the bond yield curve continually narrow. What's interesting about that is historically it narrows when they start to bring the short-term rates down. But instead, what we have is the long-term rates going up. And so it's creating the same effect, but for the wrong reasons. But there again, it's because we have relatively high inflation. Now, granted, inflation has come down for 12 consecutive months. We had a very minor uptick this last month, but for virtually an entire year, we've seen it come down. But we still have real yields around 1%. The inflation rate is still a full percent below what the long-term rates are. So it's an interesting scenario, but it does create an enormous amount of technical resistance. When we saw the 10-year hit that level, which again was right at about a 16.5-year high, it stopped and it pulled back, and we're just getting a little bit of softness right now. I'm hoping that technical resistance stays, but we'll kind of have to wait a few more days, I think, to see.
All right, let's talk about August trade here for a moment. What's your perspective on the recent pullback that we've seen from what has been an overbought market?
It's absolutely overbought from a technical perspective. In my commentary that I put out every Friday, last week Friday, I mentioned that for a couple of days in a row, we had the equity put call ratios hit what I call bearish extremes, and that means they become contrarian. And that means that they are all of a sudden bullish. So my expectation was that at the beginning of this week, we would see an uptick. Now, interestingly enough, we got a small uptick, but it wasn't as much as we typically see. You can go back many, many times, probably about the last 7 or 8 times. And almost every time we saw ratios get that bearish, we got a pretty good bounce of more than a full percent. To this point, we've only had 0.5%. So I know it doesn't look like it today, but my belief is this bounce we're seeing is not over just yet. And perhaps nothing alarming out of the Fed on Friday is maybe just what we need to get it to go just a little further. That doesn't mean we don't have more weakness to come here over the next month or two, but I think in the very near term, we're due for a little bit more upside than what we've seen thus far.
All right, Randy, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.